Hello, my name is Amy Lassiter and I am the Vice President of Marketing for Wired. Thank you for taking the time to watch our presentation about Wired's tactical and business plan, as well as listening as we propose potential future investment opportunities. So today we will be going over a few different things during our presentation. The first thing that we're going to be speaking about is the review of our financial and market performance during the past year. We're also going to be assessing the current situation and the market. We are going to be discussing our strategy for the next year in business. We're going to be talking about our financial request as well as our financial information, and we will also be showing our tactical plan.
Hello, my name is Riley Phillips. I'm the VP of Manufacturing for Wired. I will be talking about the financial and market reviews for the past year. As you can see, our financial performance increased from quarter 2 to quarter 3. This is due to our initial revenue and our continued growth of revenue. You can also see that quarter 2 was negative. This was because we had not begun selling our product. Our financial performance increased due to the increase in market share.
Hi, I'm Robin Arnold and I'm the VP of Sales Management. The top left chart on this slide shows our cash flows for the last 3 quarters. Our cash flow went down on the first quarter specifically because we didn't have any units being sold nor any being produced. From quarter 1 to quarter 2, our cash flow still decreased because of production as well as investment into market and employee surveys. Along with these, we also opened another sales office in Chicago. However, in quarter 3, we see a large increase in cash flows from negative $512,732 to positive $452,800. This is because of our high market share in our Mercedes target market and our units sold in the workhorse segment. Related to this is our market performance. As shown in the bottom right chart, our trend line is at 1,191 units sold as of quarter 3. This is about 200 more units sold than the runner-up, Noble. The majority of our sales are from our luxury brand. This is because of the high price margin as well as the high product demand we're receiving from our customers, along with the quality products we're offering to our customers. On this slide, I'll discuss the assessment of our current situation and the market. Currently, our market share is at 20% overall. This is a decrease compared to last quarter where our market share was at 26%. There was a major decrease because of our workhorse brand and how badly it did in its own market. To fix this, we redesigned the brand, creating Economy 2.0, which offers better benefits than the Economy brand did. We're sure this better brand design as well as a lower price will be a hit with the workhorse segment and gain market share in the process. Along with market share, our physical location in the market is changing as well. While we still have our Chicago and Paris offices, we are opening up 2 other offices in Brazil and Shanghai. One important decision in opening up a new sales office was the fact that none of our competitors are currently in Brazil. Although some are probably planning on going to Brazil within the next quarter, we believe with our improved workhorse brand, we will take a high percentage of market share in the future quarters, specifically because Brazil's market for workhorse is higher than the other 2 brands. We hope to expand market share overall as well as greatly increase our market share in the workhorse segment within the next few quarters.
One of our strengths is our strong market share. In the Mercedes segment, our Luxury Series brand has 49% of the market share. A weakness that we have is our equipment defects. We plan to fix this by hiring technical support in all of our sales offices. One of our opportunities is our R&D improvements that we expect to see in quarter 6. The biggest threat to our company is Noble and their Mercedes brand.
Now I will be talking about our strategy for the next year in business. First, we have a new marketing strategy. We have a new brand. It's a revamped version of our old Economy brand, and it's called Economy 2.0. It has a couple of different special characteristics, and Bryson's going to be talking about that later on. We also have kind of a different manufacturing strategy. We have our demand per salesperson at 100, and we also have luxury brand demand at 938 and Economy 2.0 demand at 462. And the demand per salesperson raised from 85 to 100 because we expect growth with the opening of our 2 new sales offices. And also, 2/3 of our sales are going to Mercedes, and that's kind of what you see, that first number of demand at 938. And 1/3 of our product is going to Economy 2.0, and we can see that with the 462 number. So also, like I just mentioned, we are opening 2 new sales offices. So this is more of our sales strategy, and we are now going global. We're opening an office in Shanghai as well as Brazil, and we anticipate hiring some more salespeople for that in the future. So we're very excited about that. And lastly, I'm going to be speaking about our human resources strategy. So we have increased the health benefits as well as salary of our employees. And this is really to increase productivity. It was a recommendation that we're excited to implement. As well, we have been utilizing information from follow-up surveys, and we're going to continue to do this to make sure that we can be as beneficial and efficient as we can be.
Hi, my name is Bryson Leip, and I'm the Vice President of Business Analytics and Marketing Research for Wired. Today, I'll be talking about our financial strategy and our request for capital. We're requesting $5 million in capital, and this investment will go toward our research and development expenses, as we're investing in a high-comfort keyboard and mouse to be available in Q5, as well as a fail-proof ultra-capacity hard drive and ultra-fast computing power to be available in Q6. This investment will also help us to grow both of our business segments and reach global exposure as we open sales offices in South America and Asia. Our projected return on investment for the end of year 2 is 30%. This is based on the growth of our revenues and our company. We have a desired stock price of $130, and we're offering a 20% share in our company for $5 million. This means we value our company at $25 million. This is based on our revenues and expected growth, our sales offices, and the value of both of our business segments.
Hello, my name is Colin Pounders, and I'm the Vice President of Finance and Accounting for our company. And now I'll be going over our financial statements. The first section I'll be going over the cash flow is the operating activities. Our revenue from Q3 was $3.6 million, and we anticipate consistent growth of around $800,000 in Q4 and up to $1 million in quarters 5 and 6, ending at around $5.8 million in Q6. As of right now, we continue to use our rebates to draw in growth for our workhorse segment, and we believe we will implement those through at least Q6. Right now, we have implemented R&D in Q4 for $1.9 million, $2.9 million in Q5, and $1.9 million again in Q6. However, even though these are large expenses, we do believe they will pay off in the future for our company. And now we'll talk about the financing and investing activities of our cash flow statement. After Q3, we do not plan on expanding our fixed operating capacity, as we do believe it is adequate to our future demand. In financing, we'll be asking for the $5 million to help fund our R&D projects and the expansion into our 2 new markets. The next financial statement I will go over is the income statement. As mentioned before, our revenues are projected to increase pretty consistently by about $800,000 and $1 million over the next 3 quarters. Our cost of goods sold will continue to increase. However, per unit, we do expect it to decrease slightly due to the increase in operating capacity. The last financial statement I'll go over is the balance sheet. Our fixed assets will stay the same, as we do not anticipate expanding our fixed operating capacity. However, our office capacity will increase, and that will increase our current assets. Our equity portion will increase, as we are expecting the $5 million that we are requesting. And we do not expect taking any debt, either emergency or a conventional loan.
This slide displays our brand and sales office's tactical plans for the future quarters. As stated before, we redesigned our Economy brand to Economy 2.0. While we don't plan on creating any other new products, we do plan on having to innovate and upgrade our current brands in the future. Our salespeople will increase to 26 and stabilize there. On our tactical plan for our brands, we show that the price won't be decreasing. We thought that this was okay because there will still be benefits to future products because of research and development, and these prices will still be competitive in the future. Next quarter, we will open up 2 new sales offices, therefore being in every location possible, and therefore creating these expenses early on, with a lower sales office expense in later quarters. Finally, our advertising expense will go up through quarter 6. We will need to advertise the new sales offices and brand developments that we will have gained through vigorous research and development. We will be aggressive in the future with our advertising.
As you can see, we expect our projected demand to increase to 1,690 in quarter 5 and 2,002 in quarter 6. We also expect a consistent increase in revenue in quarters 5 and 6.
There are a few key takeaways from this slide. First, we're utilizing our follow-up survey information by investing in system improvement. This quarter, we invested in cross-training workers, training operators to detect errors, and working with suppliers to launch quality improvement programs. We anticipate similar levels of investment in system improvement in quarters 5 and 6. Second, our research and development costs are significant in quarters 4 and 5 and less significant in quarter 6. While the costs are high, we are confident that this investment will yield a high return. Finally, we chose not to take out any loans at this time because we feel it is important to stay out of debt.
We wanted to thank you for taking the time out of your busy day to listen to our presentation about Wired. We hope you decide to invest in the great opportunities our company has and will have in the future. Thank you.